As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized CIMA professional qualification and the internationally respected CGMA designation. As a CIMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the CIMA Professional Qualification, the Strategic Case Study exam. Start studying the CIMA Professional Qualification. Prepare to make an impact.
Good evening, dear professional colleagues, students and friends of the Institute. Ladies and gentlemen, you're welcome to another episode of ICAN on Air. Today, Thursday, the 16th of February, 2023, and the 5th episode in the fabulous February series, proudly brought to you by the Institute of Chartered Accountants of Nigeria. I am your host, Olamide Balogun, FCA. On today's episode, we'll be taking a keen look at the topic, reporting prior year correction under IFRS. That is, reporting prior year correction under IFRS. And our guest for today is no other person than Mr. O.J. Samuel, FCA. A brief profile of Mr. O.J. Samuel. Mr. O.J. Samuel has 18 years postgraduate and professional work experience, which covers branch banking operations, commercial banking, marketing asset remedial management, strategy, risk management, and internal control, international banking, operational information technology, to name a few. From banks like the United Bank for Africa PLC, the acquired Continental Trust Bank, and a cut over into the Intercontinental Bank PLC and Bank PHP PLC. He won the Best Customer Friendly Officer Award and Star Deposit Mobilizer Commendation at both the United Bank for Africa PLC and Intercontinental Bank PLC, respectively. He was the pioneer financial controller of Bank PHP He was the pioneer financial controller of PHB BDC Limited, where he was seconded to from Bank PHB PLC, and was directly responsible for managing financial assets worth over 3 billion naira at the age of 30 in the year 2010. He left banking to join Charms Consortium Limited, a government co-concessionaire, as a pioneer CFO to take the financial leadership for the rollout of the National Identity Management Project for the Federal Republic of Nigeria, across Nigeria and abroad. He resigned from this role as the project would go on to be immersed in government inconsistencies with the two concessionaires involved and non-stop policy somersaults, to start a full technical consulting firm in 2014. He has consulted for both SMEs and multinationals and majors in handling complicated transactions. A chartered accountant and chartered tax practitioner by academic and professional training, he is an author of 10 pioneering published books in the areas of accounting and taxation, and the books have witnessed massive patronage among professionals across the globe. He was the lead writer of the Financial Reporting Study Pack for the professional examination of the Chartered Institute of Taxation of Nigeria, CITN. He has also served in various editorial boards. Mr. O.J. Samuel is proudly Nigerian and Black African-centric. He has been serving in numerous committees at different times at the Chartered Institute of Taxation Nigeria, CITN, and the Institute of Chartered Accountants of Nigeria, ICAN, since 2009. He is the Chief Executive Officer of Immaculate Metrics Plus and the Managing Director of OJ Inspiration Limited, both based in Ikeja, Lagos, Nigeria. Dear viewers, that was indeed a loaded profile, and I'm sure you're ready to get the benefits of the knowledge and wealth of experience of our guest, Mr. O.J. Samuel, FCA. It is sure to be an interactive session, so please sit back and relax. Call a friend who's not yet connected to dial in and connect. I'll quickly go on a brief commercial break and return to discuss with our guest. Please stay tuned. I'll be right back. Welcome back, viewers. And like I promised, our guest is fully on ground and ready to dish us with the best of all that we need this day. Mr. O.J. Samuel, FCA, welcome to ICAN on Air.
Yeah, thank you for having me once again. Thank you so much. Thank you, team. Thank you, ICAN, for this privilege and this opportunity to be with you and our colleagues. Thank you.
Thank you so much. And one thing we always press for is our time. So I'll just dive in straight in so our viewers can really get the very best from the time that we have. And I would start this way by saying, due to the global dynamics of technology and activities, we as professional accountants are ready and willing to learn, unlearn, and relearn. In order to remain relevant and competitive, having a very technical guest like you today, sir, it's an opportunity for our global viewers to learn, unlearn, and indeed relearn. Let's start this way. What is a prior year, or what are prior period errors?
Yeah, thank you. It is something we've been used to. Many years ago, those who studied accounting, who wrote ICAN exam, they have been very familiar with prior year adjustment. Everybody just jumps straight to prior year adjustment. In the days of extraordinary item and all of those adjustments you need to do. But I want us to stay with the definition of prior year errors in line with the standard. So I'm going to go to paragraph 5 of IAS 8. IAS 8 is a standard that deals with correction of prior period error in addition to accounting policies and changes in accounting estimates. So I'm reading verbatim the provision of paragraph 5 of IAS 8 on prior period errors. It states, prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods, arising from a failure to use or misuse of reliable information that A, was available when financial statements for those periods were authorized for issue, and B, could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. So this is the authoritative definition of prior period error. So there are all forms of omissions, all forms of misstatements contained in an entity's financial statement for one or more period in the past, arising from the failure of the preparer of that financial statement to use or misuse of a reliable information that was available, meaning it existed at a period when those financials, right, were prepared, and could not just that it existed, and could, reasonably be obtained at the time, but this was not considered in preparation of such erroneous financial statement. So those are the key words, right? Those are the key words. Those are the key components of the definition of prior period error. Errors arising as a result of containing misstatements, containing or it may be misstatements, it may be omission, right? In the preparation of a particular entity's financial statement, as a result of failure, there's a failure to use an information, right, that existed at the time that the financial will be prepared and could reasonably be obtained, but was not. So that is what we call prior period error. Commonly we say prior year, right? Yeah. So it may not be a year, it may be a historical 6 months ago, 9 months ago. So prior period is general, it encapsulates all those periods historical for an accounting cycle. Thank you.
Brilliant, sir. Thank you so much. What a way to start. And I know you're really, really gearing to go. And this will be an opportunity for even our student members, to quickly take down their notes. And because I know people are preparing for the May exams, you really don't want to miss this session. So for our members already qualified who are here, and you have your siblings and your loved ones who are preparing for the May exam, kindly call them to dial in, because this is really a technical session. And following swiftly, sir, I would say that are there specific IFRSs or standards that specifies how prior year corrections should be treated in the financial statements?
Very important question. There is a standard that prescribes, when we say there's a standard, it's a prescription. It tells us, the consideration, the basis, the philosophy guiding what should be done when a prior period error or prior period errors are to be corrected. And that standard is called IAS 8. IAS 8 covers three scopes of items, three scopes. A scope deals with accounting policies itself. Selection, evaluation, and application of accounting policy. That is one segment of the scope of IAS 8. The second segment deals with changes in accounting estimates. When there's a change in accounting estimate, how do we reflect it in the financial? What are the associated disclosures that go with such changes in accounting estimates? That is the second segment of IAS 8. Then the third one is the one that deals with correction of error. So that segment deals with how errors are corrected, how they are reflected in the face of financial statements, and the associated disclosures that go with the correction of such error, and also certain conditions that may make it impracticable. Some things are idealistic, but there may be other expedient approaches that may be taken to comply with such issues. So that talk segment deals with correction of prior period error. So that standard is IAS 8. We'll go to the talk segment dealing with correction of prior period error. So that is the standard. Now, secondly, there's an interwoven standard. Isn't all error we jump at correcting? I have a 5,000 naira omission for a balance sheet size of 10 million. Is that material? So, a primary use of a general purpose financial statement. Is it every error you jump after? Therefore, before IAS 8 was amended in 2018, right? It used to emphasize the concept, it defined and explained the concept of materiality, right? But with the revision done to IAS 1, a new definition of materiality was given, but was moved to IAS 1, right? So we need to read IAS 8 when it comes to correction of error in conjunction with paragraph 7 of IAS 1 that defines materiality. When is an information material? Just the way you do you see, what we call, what is the substance of what you want to achieve, right? What is the significance? What is the threshold? Every transaction, every item, every entity, every deal has a threshold. Some thresholds are meaningful, they may not be meaningful. But for IFRS, we look at it from the eye view of a primary user of a financial statement. That item that will make him or her or an entity to take an alternative decision that is capable of affecting or impacting the economic decision of a user of a financial statement. So my point is, why going through IAS 8, we should tag along IAS 1, we give the consideration, the meaning of when an information is said to be material. So that is the next one. So IAS 8, the third segment, and then the materiality concept and the conditions surrounding materiality under IAS 1. Thank you.
Perfectly said, sir. Well said. Just like they say, you can't jump to 2 without counting 1. As you're going along with your IAS 8, remember to branch at IAS 1, and so you can get the full grasp of materiality. Very well said. I know this is going to be a very technical session for us, and we're so blessed to have you on board. For our viewers who are just joining us, we've been guesting Mr. O.J. Samuel, FCA, and the topic of discourse for today is reporting prior year correction under IFRS, and it's been amazing thus far. Sir, we are set for classroom today, that I know. I have my pen with me, I have my jotter, I'm taking my notes, and I'm sure our viewers are also doing the same. How is a prior year period error different from a current period or current year error?
Okay, this is it. A prior period error, as we explained from the definition of paragraph 5 of IAS 8, these are errors committed in period before a current period. Simple. A prior period error is an error, or prior period errors are errors committed in period before a current period, but discovered in a current period. Those are the categories of error we call prior period, meaning the period before the current one. So current period error are errors that arise in a present reporting cycle, and of course spotted and dealt with in that cycle. So that makes it current. Prior period means all those other errors that occur before the current period in view. That is the difference. So the focus of IAS 8, or the focus of the segment of IAS 8 dealing with correction of error is with respect to prior period error, because of course, obviously, current period error, when spotted, of course, are affected to the relevant accounting entry, and then you move on with your reporting. Thank you.
Well said, sir. Very well said. I can see our regulars already connected all the way from Ibadan to the United States, to Canada, to India, everywhere in the world. The ICAN brand is being represented, and our members are already connected and gearing up to ask their questions. So please feel free to post your questions, and we'll be taking them as the show goes on. Sir, please, are there correction of prior year errors different from how they are presented? Let me phrase it properly this way by saying that in the process of correcting prior year errors, is it different from how they are presented in the face of the financial statements? And could you please help our audience to have a better understanding of this gray area?
Thank you. There are different things. You see, the purpose of IAS 8, when it comes to correction of prior period error, is not to tell you which account to debit or which account to credit. No, that is too elementary, right? So when you spot an error, be it current, be it prior period, right? You need to pass the necessary accounting entry in your accounting software, right? So that is not the focus of IAS 8 with respect to prior period error correction. No, the focus of IAS 8 is on the presentation and disclosure of the correction of such prior period error, right? So what evaluation do you do? How do you present it? And how do you disclose such correction? That is the focus of IAS 8. So the approach or way of preparation or presentation or disclosure is different from the way they are treated in your accounting entry. So let's go back to elementary accounting, right? Errors. There are different kinds of accounting error. Those that you mentioned errors that affect the trial balance under the mechanical or manual accounting error, right? Now, a software balances all transactions, whether it posted rightly or wrongly balances. But in the past, under the mechanical error, another the manual error, when things were done manually or a combo of certain mechanical and manual approach. Now, we used to emphasize errors that are not reviewed by trial balances. If you remember, we talk about error of omission, very elementary, error of omission, error of commission, error of principle, error of compensation, complete reverse of entry, error of double entry. You keep mentioning them. Now, those errors, we said, they do not affect the agreeing of the totals of the debit column and the credit column of a trial balance in a mechanical or manual accounting system, not in an electronic or software error, right? So this is it. Whichever category of error that has been committed, such error has to be corrected in the accounting system. So where you failed, where you committed an error of omission, what do? You pass the recognition of the transaction, right? Absolutely. You bought an item, you sold an item, you did a swap, and all of that, and such transaction was not recorded. The correct step will be to recognize it in the accounting system as soon as the error is spotted. So you are doing accounting entry, or probably there's a wrong classification or a misclassification, right? You write the classification by passing the adjusted entry. And also, let's go to a software error where you have wrongly, that what we call charting of accounts, right? When you charted an account is wrongly charted. What you read under your non-current category, for example, is reading under your current category. That is a charting error of your summary or line item. So you need to go back to do something you edit, you delete, to reinstate the line item and all that, right? So the summary, whenever there are errors, is either you're passing accounting entry to correct the error, or you are doing a chart of account reclassification, right, to appropriately align line item. Those are the things you do ordinarily. So no brainer, given basic. But the focus of IAS 8 with respect to prior period error is how you pass the accounting entry in the record. But this is where we are, Mr. Balogun. We are saying in 2022, you gave us an account. That account contained 2022-2021 comparative, and we were with it. Now, in 2023, you are giving us an account that has a 2023 current year, for example, and a 2022 comparative. But something has happened. Remember last year, you had given your shareholders or stakeholders a 2022-2021 account, for example, right? But there was an error of omission in the 2022 account as at last year when you gave it to them, for example. But now you are presenting a 2023 account to the same stakeholders or shareholders, and you have corrected an error of 2022, which you discovered in 2023. You corrected it in the 2022 column. What happens? For the 2023 account you have given me, when I look at the comparative for 2022, and I look at the same 2022 for last year, which you gave me, maybe for inventory or for trade receivable, I'm going to notice a difference in amount because in 2023, I had historically maybe corrected an omission or a misstatement. But as at 2022, when the account was given to me then, that error was not spotted. So I'm having a 2023 account with a 2022 comparative that has a line item of, say, trade receivable, different from the same line item for trade receivable in 2022 when you gave me a 2022-2021 comparative. Therefore, the focus of IAS 8 is where you correct these errors. We said it is elementary. You pass the accounting entry. No brainer. You've done that. But how do you communicate to a user, to a primary user of a general purpose financial statement who is not a member of your management, who is then entitled to the management account and other internal account? How do you communicate the correction of such error? And what are the associated disclosures that will ensure that a primary user of a financial statement is not misled in the process, or is not disinformed, or there is no obscurity of information? That is the focus of IAS 8 when it comes to prior period error correction, not in terms of telling you where to debit or where to credit.
Where to credit.
So that is the two dimension. Thank you.
Honestly, I can just let you just go on and on and on, because I know for a fact that you are really taking us to the nitty-gritty of all this. And those in practice, those preparing for their exams, this is an opportunity for us to sharpen our tools again and really dive in and get that wealth of knowledge that you've acquired over the years. And we're so glad to have you on board. Moving on swiftly again, sir. Though you've already touched on this a bit, but what are the forms of prior year errors and how are they presented in the face of the financial statements? Our global viewers need some clarifications in that area.
Okay, thank you. If you look at IS 8 clearly, it identifies two categories of error. It emphasizes that some error may have been committed in the immediate year before a current year. Let's say we're in year 2023, some errors might have been committed in 2022. Recall, this is February. By the end of June, for example, or by the end of March, let's assume we're a quoted company that prepares an interim report quarterly, right? By the end of March, we're expected to present the first quarter financials. And you now discover that, okay, we did this period last year. There was an error we committed. We need to rectify it, right? So that's the case of a prior period error arising from the comparative year, right? So that is alluded from the explanation given in IS 8. Now, there's another kind of prior period error. What happens if the error you are correcting or the error you spotted occurred 5 years ago? Wow. 5 years ago, you are in 2023, but this error occurred, let's say in 2017 or 2018. And in Nigeria, commonly, we present a 1-year comparative financial information. True. Right? Apart from when you are doing a 5-year financial summary, a 3-year financial summary, depending on the case may be, but that is just a summary. But operationally and practically, the practice in Nigeria is that we prepare a 1-year comparative or a 1-year historical account, so to say, a current year and the just gone cycle for the accounting year. So for an error committed 5 years ago, how do you reflect the correction of such error? Recall I said, we're not talking about debiting where or crediting where. That is done in accounting software or system. That is gone. We are saying, how do you reflect, how do you present the correction of that error, and how do you attach the appropriate disclosure for errors that were committed years before last year? So ordinarily, if you have to start with the 1-year comparative, the correction of such error will not be obvious in the financials, right? Therefore, IS 8 principle, exposes that there are two kinds of prior period error. We have the comparative prior period error correction, right? That is a correction dealing with the immediate comparative year error. And we have pre-comparative. This is not stated in this word in the standard, but those are practical implications of the nature or form of error that can arise. So we have pre-comparative prior period error correction. And that covers all categories of error correction that arise from errors committed in years before the comparative year. So two categories. Those errors that have been committed before a comparative year, one. Then we have those errors that arose, right, in the comparative year. So that gives us the pre-comparative period or pre-comparative year errors and the comparative year error. So what is the difference in the way they are treated? Now, let's start with the comparative year. When year 2023, for example, preparing a 2023 account, then we have a 2022 comparative, and there's an omission of a sales to an associated company or to a related company last year. That was an omission. 2022. Now, in 2023, we now discovered such omission of entry. Now, you pass the entry, credit, last year had gone, right? We're in this year now. Okay, do you know what? Well, let's go and credit inventory for the sales or debit cost of sales. And then, let's recognize the profit element in retained earnings. You pass the accounting entry, accounting-wise. But in the presentation, what the standard says, when you are correcting a comparative year error, the correction is reflected in the line item, under the comparative year in which that error was corrected. For example, there's an omission of sales in 2022. In 2023 financials, when we present revenue as a line item in our statement of comprehensive income, of course, we have 2023, which is the current year. We do not have issue. But that omitted revenue, which we are recognizing, should be added to the former figure of revenue for 2022 and presented alongside as if no error was committed. As if no error was committed. That is what we call retrospective restatement. We are stating a comparative which is reflecting a correction as if, we are just stating it normally. Instead of you saying, okay, this one now plus this. No, we state the whole amount inclusive of what the right amount should be for revenue. We proceed that way. Recall, as affects revenue for 2022, which is the comparative year, is going to also affect cost of sales, right? And
yes.
it will trickle down that way.
Trickle down.
And remember, the profit of the year for that 2022, which you are restating, the profit for the year for 2022 will now be added to the opening balance. It will now be added, right? It will flow ordinarily to the opening balance of retained earning, and then you proceed in the normal way you do it in your statement of changes in equity. You know the way you present in your changes in equity, statement of changes in equity. The profit for that comparative year, you present it under 2022 in the statement of changes in equity. So if you look at that approach, it does not communicate obviously that there was an error in 2022 which has been corrected. So it is retrospective restatement. It's only through disclosure that you now draw the emphasis, trying to clarify the correction or recognition of appropriateness for what was not previously so in error. So that's how you deal with comparative year error correction. Those errors that arose in the comparative year. Now, to the second category, the errors that arose before the comparative year. So you're not going to say, okay, because it happened 10 years ago, let us then prepare statement of comprehensive income for the next 10 years historically, for the past 10 years. No, we don't do that. So for any correction related to any year before a comparative year, the net effect of that correction, meaning if that correction has an impact on profits, right? Some errors may not have impact on profits, some may do. For example, you bought an office furniture, or you bought, let's say, okay, you bought inventory, for example, inventory, and that inventory is not yet sold and it is omitted. That inventory you bought will not affect profit if there is no impairment. For example, if there is no impairment, the only thing that it did not reflect is the impact of that purchase either on bank and on inventory, right? If that inventory was not sold. So ordinarily, it won't affect profit if impairment does not arise. But some other transaction may involve an omission or error that has a profit implication. So for all those errors committed before a comparative year, the net profit or loss implication, right, is adjusted straight to retained earnings. In the face, please get me. I'm not saying you do not pass the accounting entry. You are past the accounting entry. We are saying in the face of the financial statement, the net effect of the profit or loss on that error you are correcting is reflected in statement of changes in equity. So let's stay with our 2023 accounting year, for example. This runs from January 1, 2023 to December 31, 2023. The comparative will be January 1, 2022, right, to December 31, 2022. And you committed a 2017 error. And the impact of that error is that profit, it was an omitted sales. Profit should have been increased by 50 naira or let's say 5 million naira. So in your statement of changes in equity for the year ended December 31, 2023, recall the comparative will be December 31, 2022. But this profit you have to recognize of 5 million was on a 2017 error which you've corrected and which you spotted and you are correcting. So what you do is to add that 5 million profit element, that incremental, you add it to retained earnings. So if you go to your statement of changes in equity, there's a column for equity, ordinary share, there's a column for retained earnings, right? So in the opening balance of January 1, 2022, you are now going to add the resultant profit implication of that 2017 error which you have corrected. You add it to that retained earning opening balance for the comparative year.
Yeah,
to
brilliant.
now get what we call
Absolutely brilliant.
opening balance restated, and then you proceed.
Yes.
So just in summary, pre-comparative error correction, where there are profit implication, are reflected in the opening balance of the comparative year item in the statement of changes in equity. But comparative year error correction, right, that affect profit are presented alongside the line item concerned as if no error was done in that comparative year, which are referred to as retrospective restatement.
Yeah.
Thank you.
Wow. Thank you so much. Like I said, it's indeed a technical session for us, and we are getting more than we bargained for because you've really taken us through the in-depth, and we're really, really grateful for that. Experience has shown in this ICAN on Air that anytime we deal with technical sessions, viewers are always there taking notes, and I'm sure they're really taking notes and preparing just to get more and more from you. Time is not our friend, so we'll just be moving swiftly. But I have a question from one of our viewers. That's a person of Adewumi Olabode. Just a quick question from him. He's saying, does additional tax liabilities from tax audit exercise qualify as prior year error?
Straight answer, no, it's not an error, right? That is an impact of a change in an accounting estimate. There is a change in accounting estimate because, when you prepare your tax obligation, you assume, okay, these expenses are liable, this income is exempt, this one is taxable, this one, that's how we call it, is a provision. It's a provisional accounting. Under IS 37, you make a provision for tax liability. Now they come for a tax audit 3 years after to say no. You didn't tax this, you didn't tax that. They now prop up items that constitute increase in your tertiary education tax liability, in your common income tax liability, in your information technology development levy, in your, just mention it. Those additional tax liability arising from audit is a function of a change in an accounting estimate because the entity had estimated in their judgment while preparing that this is what the liability will be, but an audit has thrown up the impact of a upward revision of the tax liability. So that is not a prior period error. Why is it? Go to the definition we said before. We said, well, that information, is it an omission? Is it a misuse? Was that information available at the time? And was it not used? So that was why we went to that definition initially to know what a prior period error. So this is a case of a change in an accounting policy. It is not a prior period error. And how is it treated? Any change in an accounting, change in accounting estimate. Any change in accounting estimate is prospectively treated. You don't go back to the past. You report the tax implication in the current year and you move forward. That's what we call prospective application. That is a change in an accounting estimate, tax audit impact.
Brilliant, sir. Thank you so much. And it's as if Muyiwa Olajide is probably just reading your mind because he also has a question here. He's saying, well done, sir. Because we all know we're getting value for our time here. So he says, well done, sir. But he now says, please, sir, more clarification on prospective and retrospective. But I know you already touched a bit on that, okay?
Okay, let me just say a quick one. ISS is clear. When we talk about an accounting policy, let's say there's a change in an accounting policy. Depending on the standard governing or prescribing what is to be done with a new accounting policy, that accounting standard may prescribe that you do a retrospective application. A retrospective application of accounting policy is the application of accounting policy to historical or past transaction as if that policy existed at the time of those past transactions. That's what we call retrospective application. Applying an accounting policy to a past or historical transaction or to transaction or prior period as if, even though the policy came up this year, for example, but you applied it to 2022 as if it existed in 2022 when the transaction, event, or condition existed in 2022. That's what we call retrospective application. Now, that is accounting policy, right? Now, when it comes to prospective application, it simply means applying all effects on an item from a current period going forward. You do not go back. You apply it from the current period and you proceed. Whereas retrospective, you go back and apply that policy change or retrospective restatement effect. So one means applying backward historically, one means proceed from where you are. That makes it prospective. And it is common, it is associated as a matter of principle with changes in accounting estimates. But accounting policy, the policy may say apply this change prospectively. It may say apply it retrospectively. It may give you an electional option where you choose whether to prospectively apply the effects or to retrospectively apply the effects.
Thank you. Brilliant. Thank you so much, sir. So our guests who are just joining us, well, you've missed about 40 minutes of the show, but we still have a bit of 19 minutes to catch up, albeit we are moving as fast as we can. We've been guesting Mr. O.J. Samuel, FCA, who has been deep diving into the topic, reporting prior year correction under IFRS. And I dare say he has been doing an amazing job, and we're really grateful for that. So let me move on to this question by saying, based on your wealth of knowledge and skill in these technical subjects, what specific components of the complete set of financial statements are affected by the presentation of correction in the financial statements?
Okay, generally, the components of IFRS financial statement, we have the statement of financial position that we know we have a statement of changes in equity, we know we have the statement of financial position, we know we have the statement of cash flows, right? Then we have notes to the financial statements, right? These are the core, the center. Then the statement of accounting policy, right? Another disclosure, extension, right? Or expansion of the content of these ones we've mentioned. So when an error occurs, what are the components that are affected? Generally, if that item affects profits or loss, that means it's going to reflect the true, it's going to be presented. Remember, I keep emphasizing, I'm not talking about accounting entry correction, no. So if an error correction has an impact on profit or loss, that means it's going to be presented and reflected on a line item contained in statement of statement of comprehensive income, rather. But if the error is an item that borders on asset or liability, right? Asset or liability, and or equity, of course, it's going to affect that line item in the face of statement of financial position. But recall, even if an item affects any item that affects profit or loss, automatically, if you are talking about pre-comparative, I emphasize pre-comparative prior year error, if that item affects profitability, right? Automatically, it affects the equity component of your statement of financial position. So if it affects your statement of financial position, that will mean, of course, to affect your statement of cash flow, because the cash flow is merely the movement between an item between a certain date and a certain date, whether they're investing, financing, and all that. So these are the components, these are the crux. Statement of financial position, statement of comprehensive income, statement of cash flow, and also statement of changes in equity. If the correction has a profit impact that occurred pre-comparative year period. I've said before that such corrections are adjusted on the opening balance of the comparative year to arrive at what we call opening balance restated in the comparative year. That's the nature of error which have impact of profit or loss that had occurred before a comparative year. So these are the four components that on whose presentation or recognition of correction in the field of financials are reflected. These four.
Very well said, sir. Very well said. And I'm sure moving swiftly from that, by the time the financial statements are prepared, the next thing that comes to mind is, are there income tax implications associated with correction of prior year errors? And if yes, how are they treated? And if no, why?
Oh, thank you. So the question is, the correction of the error, will it affect your assessable profit? You know, will it have formed part of the company or associated from? If it does, of course, that's implication. So depending on whether you are a small company, when you're a small company, the question is, as when Finance Act 2019 began, it began February 1, 2020. If that profit error correction arose in 2019, you are going to pay the tax associated with that, because Finance Act 2019 that recognized a small company commenced February 1, 2020. So you don't say, no, I'm a small company now, leave me alone, this is 2023. No, the question is, that prior period error, did it occur before 2020 February 1? If it does, and it has a profit implication, which ordinarily form part of your assessable profit, then the tax implication has to be recognized. That is that. So when you're a medium-sized company or large company, of course, that is absolute. There is no case of where you're exempted or where you're not. So now, how will the tax liability reflected in the face of the financial? I keep emphasizing, we are not here to talk about accounting entry. That is elementary, right? It is given, known. So the tax implication of such, let me be clearer. The income tax implication, I'm not talking about VAT now, or stamp duty, right? So the income tax implication of such error, which are correcting, for the comparative year error, you know, after what you used to call profit before tax those days, there's no line item clearly now currently called profit before tax, because there are various line items here and there. But there's a line item before tax expense, right?
Absolutely,
so
yes.
When you are doing a correction in a comparative year, that correction that has a profit will have dovetailed into getting to the point where you have the PBT, so to say. Therefore, the income tax implication, either increase or decrease, whatever it is, in your income tax provisioning or income tax expense to be recognized, is also presented under that line item, tax expense. But that will be for the comparative year under which the tax implication is arising on the correction of the error. Now, what happens if the tax implication arises on an income or gain associated with years before, hear my word, before the comparative year? That means no item of tax expense, either for the current year or comparative year, will be affected. No, rather the tax implication directly is going to be added to the opening balance of current tax payable for the comparative year, right? You know the way you do your aggregation, opening balance, tax for the year, payment. So that is why you factor it in to get to a closing balance, which is contained in your statement of financial position. That is the way it is.
Honestly, believe me, I know that come the next induction, a lot of the people that will be inducted as a new associates will come and say a big thank you to this, because believe me, you are really, really giving us the nitty-gritty of all that we need to get from this topic, and we're so glad to have you on board. As we custom gradually, let me follow up with this question by saying, what is the nature of disclosure associated with presentation of correction of prior period errors?
Okay.
That's how we go here.
Yeah, it's very important. You cannot, if you look at the 2018 amendment to the concept of a materiality, it emphasizes obscuring, to obscure an information. So you may not have omitted an information, you may not have misstated an information, or you might have obscured it. Obscuring means presenting in such a way, right, to mislead or to deceive or to escape the impact of the implication of such information in the face of the financial. Therefore, when a prior period error is corrected, it's not enough to present it the way we've been analyzing. No, you need to do a disclosure, bringing to the knowledge of the reader or user of the financial statements that this error occurred on trade receivable, or on inventory, or on biological assets, or on intangible assets, or on investment property, PPE, call it anything. You need to bring it to attention that an error of extra amount occurred in so year. This was corrected and led to an increase by so amount in the line item concerned. So those are the disclosure required. Most of our practitioners, most time we don't want to admit that we do mistakes, right? You see people commit error in financial, when they correct it, they are silent, no comments. If such error correct is material, right? You are obscuring a fact. You are obscuring, you are actually misleading because you are not faithfully representing information. You are tilting it. It's unfair, it's unbalanced, right? So the standard gives a requirement that please, you need to disclose all corrections made. You need to disclose all corrections made and how they've affected that item, and even ultimately how they've affected equity, because that is the bottom line. So there's a disclosure catch that has to be fulfilled as well, in addition to all of the presentation and the indexation, true notes, and all that. Thank you.
Thank you. So in that vein, would we say, are there regulatory sanctions or penalties that go with errors? There's maybe non-correction of errors or wrong disclosure of corrected errors. So follow
Thank you.
that. Yes.
In fact, there is a simple way of knowing what errors can look like in the Nigerian reporting climate. In 2014, the Financial Reporting Council of Nigeria issued a guideline, financial reporting guideline, stating what and what you do if you're an auditor, if you're a CFO, if you're a CEO, if you're signing a financial, if you're any of those parties that sign financial, all of them. Then if you go to the last section, the appendix, which one I want to focus, it listed categories of infractions, errors, that when you fail to comply with those things, that they constitute errors. And it has six categories of what they call, in quote, offenses. We have category 1, it has its own penalty. We have category 2, up to the 6th category. Therefore, failure to present a financial statement or a set of financial statements that shows contradiction or that falls short of all of those cautions, red flags, as contained in the financial reporting guideline, is already error, no doubt. And that sanction here, the sanctions are there, ranging from millions to billions of naira and all of that, depending on whether is it a type 1 error, is it a type 2 error, is it a type 3 error, is it a type 4 error, is it a type 6 error, and all of that. So there are sanctions, and that is the more fact why practitioners, preparers, auditors, right, and anyone who signs a financial statement should be familiar with the consequences to ensure that the reporting process complies as much as they can with the prescriptions of standards and all guidelines that may be issued by the Financial Reporting Council of Nigeria.
Wow. Thank you so much, sir. That's brilliant. And I know in the course of our discussion, you've been mentioning that, we are no more in the manual era. This is now the digital era, so whereby accounts are easily balanced on their own. So this will bring me to this question that what is the actual treatment or impact in accounting software in the current year or prior year error corrected?
Okay, very good. All of us are used to, I think it's common with bankers. When we're banking, we talk about end of day.
Oh, yes, end of day.
In the software world, things are developing over time. When we close our book, when we are done with the day, we run what we call an end of day on the software. That means, it simply means to close your book. Simple. That's what it means. So this is the point. When you have closed the accounting record in a software for 2022, you now discover in 2023 there's an error you need to correct. You don't go back ordinarily. You don't go back to open that account to begin to debit or credit. That is history. Practically. So if you are going to say, okay, the impact of these sales mean, let us credit, okay, inventory should have reduced by 50 million naira, sales should have increased by 80 million naira. Use it as an implication. We said inventory should have reduced by 50 million naira, sales should have increased by 80 million naira. That means there's a 30 million naira profit. There's a 30 million naira accounting profit, right? 80 million minus 50, 30 million. We'll now take that 30 million multiplied by, on average, 32.5%, meaning 30% for SITA, 2.5% for third month, right? So
yes,
2.5 times 30 million will give you the tax implication that is a current tax liability. So your accounting entry will be credit sales 80 million, debit inventory, credit sales 80 million, right? Okay, let's do it this way. Okay, we are going to say, because we are doing a movement, so we are doing a movement, we are going to say, okay, we are crediting inventory for that amount. We are taking it somewhere, 30 million. Then sales, remember sales for 2022 is already gone. There was no way we are going to do it. There was no way you could have done it. So we are going to say, okay, debit the debtor or debit the bank, depending on how that sales was made, 80 million naira. So as I'm debiting the debtor or debiting the bank for the collection, the creditor is coming to this account where you have debited the effect of the inventory that was sold of 50 million. So you have a credit of the sales of 80 million, a debit of the goods sold of 50 million. There's a 30 million naira profit. That 30 million has suffered a tax liability of 32.5%.
Yes, please.
Leading to additional entry where you say credit current tax payable this amount, right? Debiting that 30 million naira also to reduce it further. The resultant is the amount you take to return earnings. So ultimately, you are going to credit return earnings. So all of this entry I've mentioned, you don't go to open 2021. It is history. You just pass the accounting entry in the ledgers, in the book of accounts, on the software, the way they are. Even though they are related to past year, you can't open up. I'm talking practically. In most accounting software, you don't go and open past accounting software. You pass the accounting entry presently, even though they are about correction of an error that had occurred before. It's only the presentation and disclosure that you follow all the prescription we have said before now. That is how it is done practically.
Brilliant, absolutely brilliant. One thing we always press for on this show is the time. I mean, the time just flew so fast, but I know for a fact that my viewers will be yearning to have you back before the May exam because they are taking notes, they have their questions pouring in, and they still have more questions to come. So, in closing, because we just have barely 2 more minutes to go. So, in closing, so I would say, ICAN is always open to ideas that will positively advance the growth of our members, the accountancy profession, and the Nigerian business environment. Please, what is your advice or suggestion to ICAN as a body on boosting our members' knowledge in reporting prior year correction under IFRS? Just in 2 minutes.
Thank you. Good question. ICAN is already doing that. I will continue to thank them for ICAN on Air initiative. It's a wonderful initiative. The general section, the technical section like this, where members need to log, and it's free. Come on, what else do we need? It's free. So members need to log on to begin to pick knowledge. Nobody is a tree. Nobody is an island. We keep picking knowledge across the board and enriching the body of competence for compliance. So we can only say ICAN should keep bringing to the nature of a member to keep doing initiatives like this, attending our mandatory training here and there, attending technical seminar and workshop. In all of this process, we're empowering that pool of experts in Nigeria who will ensure that they present account free of error or correct such error when they arise in line with established standards and procedures. Thank you.
Mr. O.J. Samuel, FCA, believe me when I say a round of applause is not enough, but believe me when I say we sincerely thank you on ICAN on Air. And all our viewers are also saying a big thank you to you. And I do believe that by the time we reach out to you again, you'll be more than ready to come on air to share more with our viewers. Definitely. Thank you so much. We're grateful. To my viewers, that's the show for today. We've been guesting Mr. O.J. Samuel, FCA, who took us through, reporting prior year correction under IFRS. And I dare say that he did an amazing job. And to all our viewers who sent in their questions, the ones that we couldn't take, I sincerely apologize for that. But not to worry, you can go and watch this all over again. And by the time the year goes on, we'll definitely have Mr. O.J. Samuel come on board and even bring more of our people to come and talk more on this topic. As I usually tell you, please always stay safe. Remember that the Institute portal is open for the fellowship conferment. If you want to be playing with the big boys, as they usually say, he's talking about IFRS. I'm sure a couple of FCAs, by the time you wrote your exams, you were dealing with SAS then. But if you want to become an FCA this present year, the portal is open. Kindly go on the ICAN portal, which is ICAN-ngr, and kindly go there to fill the fellowship conferment form and make the necessary payments. Also, in the same vein, the annual subscription is due. The SCA category and the FCA category, please do the needful as you propose in your heart to quickly pay. There are a lot of benefits attached to being a financial member of our great institute. Until I come your way again next week, Tuesday, with another entertaining and educative topic and guest. This is Olamide Balogun, FCA, saying thank you for tuning in on behalf of the president, the registrar, the editorial board, and all people engage in the back end to ensure that this show comes to you every Tuesday and Thursdays. We say thank you, bye for now, and stay safe.